Okay, let's just dive right in. If you've ever looked at a company's financials, you've seen the two big ones, the income statement and the balance sheet. Now, they might look like totally separate reports, but they are deeply, fundamentally connected. And honestly, understanding that connection is like unlocking the secret language of a business. That's exactly what we're going to do right now.
I love this analogy because it frames it so perfectly. Think of your business over, say, a month or a quarter. All the action, the drama, the sales you made, the expenses you paid, that's the story, right? It's the novel. That's your income statement. And the balance sheet? Well, that's the final page, telling you exactly where everybody ended up when the dust settled. So, to break it down even more simply, the income statement measures performance over a period of time. It's like a video recording of your business in action. The balance sheet, though, is a snapshot. It's a single photograph of your company's financial health, what it owns and what it owes at one specific moment in time. The key is that the action in the video is what creates that final photograph. Let's see how it works. Every business story has to start somewhere, and it almost always starts with a sale. This is what we call the top line of your income statement, and it is the very first domino to fall, creating an instant ripple effect right onto the balance sheet. Okay, now this is where it gets really interesting. This is our first big connection. Let's say you make a sale on credit. The moment you make that sale, you get to recognize it as revenue on your income statement. But, and this is key, at the exact same time, an asset is created on your balance sheet called accounts receivable. It's basically an IOU from your customer. You've earned the money, but you don't actually have the cash. Not yet. So, you've made the sale. It's on the books, great. But the story isn't over, not by a long shot. The next chapter is all about actually collecting that cash. And this part of the plot, it happens entirely within the world of the balance sheet.
And check this out. When your customer finally pays that invoice, your accounts receivable, that IOU, goes down. And your most important asset, cash, goes up. Now notice something really important here. The income statement isn't touched at all in this step. The revenue is already recorded back when you made the sale. This is just your business swapping one type of asset, or receivable, for a much more useful one, cold, hard cash.
This whole cycle from making a sale to actually getting the cash is so critical that, of course, there's a metric to measure it. It's called Days Sales Outstanding, or DSO. It answers one simple but absolutely vital question: how long does it take us to get paid? And calculating it is actually pretty straightforward. You just take your accounts receivable balance, you divide it by your total credit sales for that period, and then you multiply by the number of days in that period. So let's use the example right here. We've got $2 million in receivables divided by $1 million in sales, and we multiply that by 31 days. And boom, the result is 62 days. Now, what does that actually tell us? It means that this company has to wait, on average, more than 2 months after making a sale to see that cash hit its bank account. That is a long time to wait, and managing that delay is absolutely key to survival. Okay, so we've made a sale, but to make that sale, we had to sell something, right? So let's move to the next part of our story on the income statement, the direct costs of the stuff we just sold. This is another one of those beautifully direct connections. When a product is just sitting in your warehouse, it's an asset on your balance sheet called inventory. The moment you sell it, it's not your asset anymore. Its value literally moves from the balance sheet over to the income statement, where it becomes an expense called cost of goods sold, or COGS. Now, on the flip side of measuring how quickly we get paid, we also need to measure how quickly we pay our own bills, and this is called Days Payable Outstanding, or DPO. It tracks how long we take to pay the suppliers who gave us that inventory in the first place. In our example, this company's DPO is 78 days. So let's put this together. Remember, it takes them 62 days to collect cash from their customers, but it takes them 78 days to pay their own suppliers. And this little difference sets up a really, really powerful strategic advantage. And right here, this is the golden rule of cash flow. You want your DPO to be higher than your DSO. Why? Because it means you're collecting cash from your sales before you have to turn around and use that cash to pay for the goods you sold. You're effectively using your supplier's money to finance your business for a little while. That is just smart cash management. Of course, there's way more to running a business than just the cost of your products. You've got salaries, marketing, software, rent, the list goes on. These are all operating expenses, and every single one of them creates another link between our two statements. Let's just look at a few examples. You run payroll, right? That's an expense on the income statement that directly reduces your cash on the balance sheet. Or you get a bill for marketing. That hits your income statement as an expense and increases a liability called accounts payable. And then you've got weird non-cash expenses like depreciation, which reduces the value of your equipment on the balance sheet over time. See, every action has a reaction. So the story has unfolded, we've made our sales, we've paid for our goods, and we've covered all the other costs of running the business. We are now at the climax of our story, the grand finale, the famous bottom line. This is the big question, isn't it? After everything is said and done for the month or the quarter, what happens to that net income, that profit you've earned? It can't just disappear into thin air. And this is where we find the most important, most direct connection of all between the income statement and the balance sheet.
And there it is, the final beautiful connection. The net income from the very bottom of the income statement flows directly into a section of the balance sheet called retained earnings. This is the moment where the story of the period, the novel, gets permanently recorded in the ending snapshot of the business. So what are retained earnings? Well, the name kind of gives it away. It's the sum of all the profits the company has ever made in its entire history that it has chosen to keep or retain in the business. It's how the owners stake their equity in the company grows year after year from running a successful operation.
Okay, let's do a super quick recap of the whole story. You ready? Sales create a receivable on the balance sheet. Selling inventory moves an asset from the balance sheet to become an expense on the income statement. Operating expenses drain your cash or create liabilities. And finally, the bottom line profit from the income statement becomes a permanent part of the owner's equity on the balance sheet. See, it's one continuous story. And that's the connection. It's not two separate, boring documents. It's a cause and effect narrative told with numbers. The income statement tells you how you did over a period of time, and the balance sheet shows you where you are now because of it. By understanding how they link together, you're no longer just reading numbers on a page. You're reading the story of a business.